In 2008 and 2009, we were treated to a spectacular show. We watched as Bear Stearns went belly up, as Lehman Brothers vaporized, and as the money market almost completely seized. AIG and a host of other insurance and financial companies almost went away as well. And all because of what was hidden from sight in the world of financial instruments. The timeline, events, and interrelationships were all very complex, but the root cause underlying all of the near vaporization of the entire financial system was something that was very cleverly hidden. Mortgages were packaged up and sold to investors such as insurance companies who were hungry for high yield on a safe investment. But the packaged mortgages were anything but safe. Despite having high ratings given to them by the rating agencies, the collateralized mortgage obligations were filled with questionable loans made to financially overextended people to buy overpriced homes with little or no money down to provide security to the lender. But the lenders did not care. They didn't have to. Their goal wasn't to own the debt and to get paid interest and principal over time. Their goal was to make money all at once by packaging and selling the loans to others. There were bad loans mixed with some good ones, and the ratings agencies were paid to put a pretty wrapping on the overall product. But as Michael Lewis cleverly said, the actual product was dog shit wrapped in cat shit. But how were buyers of these instruments to know? The debt was highly rated, and it was backed by housing as collateral. Who would have known to be suspicious? The world of financial assets and financial promises is complex, and often it is difficult to know all of the details necessary to make good decisions when you buy them. And even if you don't have a choice whether or not to participate, as is the case with Social Security and many other public and private pension plans, the details are still opaque at best and obfuscated at worst. For example, let's say you buy the stock of a publicly traded company. How will you find out everything that you need to know about that company? What are its implicit obligations to its employees? Has it promised to pay them pensions for life upon retirement? If so, how many employees will be retiring over the next few years? How much money has the company set aside to meet these obligations? Did they assume an 8% rate of return on their investments, only to achieve at best 4 or 5, leaving their pension fund very much underfunded? And about the overall capital structure of the company. Has the company been borrowing large sums of money in the debt market to buy back their shares? Short term, this might make the shares look very attractive. But will the company be able to meet their debt obligations long term if revenues decline? Has the company made their earnings look artificially good by excluding unfavorable currency exchange rate movements or simply not reporting special one-time events? Oftentimes, one can only learn what they need to know by obtaining the annual report and reading through all of the footnotes, which, by the way, seem to be much longer than the main content of the annual report itself. And even if you get through all those footnotes, do you really have the full story? What about the financial derivatives that the company might be involved in? They are under no obligation to mark them to market. So what are those worth? The company can assume that they are worth anything that their models tell them that they are worth. And in a world where derivatives total somewhere in the neighborhood of $1 quadrillion in total, this type of information can be quite important. There are lots of hidden factors when it comes to stocks, or any other financial investment for that matter. And the things that are generally hidden turn out to be to the advantage of those who are selling the financial instruments. They do not generally favor the buyer. So when investing, what is one to do? Sure, a person can buy a mutual fund and try to diversify away the risk of the unknowns by owning shares in lots of different companies. But if, as was demonstrated in 2008 and 2009, all of the companies are doing the same thing, how does diversification provide protection against the unknowns that are out there? After all, think about the derivatives. If there really are $1 quadrillion worth of derivatives which can be valued in an arbitrary way, and if the gross world product is only $80 trillion or so, then one can conclude that there are a lot of unknown risks out there. One can certainly choose to play the game. After all, the promise of being paid simply for owning something as opposed to working for a wage is certainly alluring. And I won't judge you if you do. After all, I personally participate in the game to a limited extent myself. The company match and the tax deferral on the first 5% of my salary is too good to pass up. But even if you make the conscious decision not to play the game that the financial markets offer you, you're probably forced to participate to a certain extent. Take, for example, the Social Security system here in the United States. Unless you are clergy, you have no choice but to participate. The U.S. government requires deductions to be taken out of payroll. The amount of money you probably have at risk, or will someday have at risk, is substantial. And I'll give you an idea of just how substantial it might be. Suppose you have decided that you would like to maximize the payment that you will get from the Social Security system by delaying payment until you reach age 70. Many people do this because every year that you delay taking payments, the benefits paid go up by 8%. Further, suppose that you have paid a substantial sum over your lifetime into the Social Security system. Your stated benefit might be as high as, let's say, $40,000 per year for life, if you start at age 70. But what is that worth in terms of your total risk exposure? Well, I'll tell you. If you were to buy an immediate annuity from an insurance company when you turn age 70 to provide you with the same stream of income, it would cost you close to $1 million. So this is pretty serious exposure to a financial obligation. I bet that even if you do not reach the maximum every year in terms of your payments to Social Security, your own exposure is probably pretty significant. You can do the math. If a $40,000 stream of payments for life starting at age 70 is worth close to $1 million, then if you will be due, say, $20,000 per year, then the value of that stream of income will be worth $500,000 in total. So like it or not, even if you think that you are choosing not to play the game, you're still in it. But what kind of hidden risks are there in the Social Security system? Isn't it an obligation of the U.S. government? Can't the government just create the money that it needs to meet its obligations? Yes. Alan Greenspan said as much when he stated that the Federal Reserve can guarantee the nominal payments will be made, though they can't guarantee the purchasing power of those nominal payments. So changing the value of the currency in order to meet its obligations to you is one of the hidden risks in this particular financial obligation that we call Social Security. Are there others? Sure. They can simply change the rules. One way to do it is to change the age at which you are eligible to start receiving benefits, as they have done in the past. Another way that they can change the rules is through means testing, and this is something that's been talked about recently. They can reduce the amount of Social Security that you are due based upon your income at the time, or even on the value of the assets that you have in your bank and brokerage accounts. For example, suppose you go into retirement thinking that Social Security will be paying you $40,000 per year starting at age 70. There is always a risk that the government will say that they will reduce your eligible payments by 10% for every $100,000 of your net worth. That would certainly be unfortunate, but one could see the government adopting this type of measure because it would be politically palatable to the majority of voters. If that were to happen, wouldn't it be nice to have a significant portion of your net worth in a form that isn't readily seen? And that brings us to gold and silver. Gold and silver will move you to the other side of the table in this game we play. Rather than a myriad of items being hidden from your view, gold and silver are items that are hidden from theirs. Think about that for a moment and let it sink in. When you participate in the ownership of financial assets, the things that are hidden from you are risks that can hurt you. When you own gold and silver, it is the gold and silver that are hidden from their view. Sure, gold and silver do not pay interest, though what does these days, and they don't pay a dividend. But what kind of value might gold and silver have as a result of moving you to the other side of the table? Consider the rule change that I mentioned a moment ago with regards to Social Security. If you had a couple of $100,000 worth of stock in a 401k account, and the government said that they would reduce your Social Security benefit by $8,000 per year as a result, that $8,000 per year reduction in benefits has an annuitized value of $200,000. Do the math that I suggested, and you'll realize that this is true. The net effect would be that the government shell game just relieved you of all of your savings. If, on the other hand, you held that $200,000 worth of asset in gold, then nobody would know about it. You'd collect your full Social Security payment because, for all intents and purposes, you would appear to be a pauper. Of course, this is only a fabricated example. Things could play out very differently. But the point is that the privacy of gold and its ability to move you to the other side of the table is worth something. And only you can decide how much it's worth to you. But most people don't consider the other benefits of having hidden wealth. Are you concerned about lawsuits? It's a very real risk nowadays. Somebody hurts themselves on your property, and even if they weren't supposed to be there in the first place, they can sue you for damages. Get into a car accident? Even if it wasn't your fault, the person in the other car can sue you for damages as well. Having liability insurance is very important to cover you, but even that won't be enough if you have significant visible wealth. Every dollar you have in a bank or brokerage account is discoverable. If your liquid wealth is significant, then the counterparty can sue you and try to get all of it, even if your insurance has significant coverage. Only money in your 401k, and in some states, your IRA, is exempt from lawsuits. Have some gold and silver in a vault somewhere? That's wealth that won't be seen. You have the opportunity to look like a pauper, even if you are not. Personally, I think this type of insurance is better than any insurance that you can buy from an insurance company. So to end this video, let me leave you with this. When we are dealing with wealth, there will always be things that are seen and things that are unseen. In the financial assets realm, the things that are not seen work to the advantage of those who are selling you these obligations, and generally to your detriment. Gold and silver themselves are things that are hidden, but unlike financial assets, the fact that they are hidden from view can work to your favor. They can move you to the other side of the table, and only you can decide how much that's worth to you.